Look around you. Almost every major commercial skyscraper, global tech interface, and private equity fund is quietly controlled by a specific, invisible tier of the financial elite. They play an economic game entirely separate from the chaotic retail public. It often feels like no matter how hard you work, save, and sacrifice, some people seem to be moving much faster than you are. Building wealth follows a specific sequence. It starts at stage 1, defensive risk, moves into stage 2, operational equilibrium, and finally reaches stage 3, institutional command. Your strategy is dictated by the volume of capital you control. You cannot access the self-sustaining strategy used at the top until you successfully manage the high-friction retail game at the bottom. Defensive risk is the reality for most people between ages 18 and 22. You trade finite biological hours for a baseline salary to cover immediate survival needs, leaving you vulnerable to any market shock. To escape this, you must carve out 10% of your income to build a foundational $500 to $1,000 emergency fund. It's a small buffer, but ensures you can handle a basic emergency without relying on debt. From there, you push toward operational equilibrium. This is the phase where your inbound cash flow exceeds your monthly infrastructure overhead. This requires eliminating high-interest debt and building a 3 to 6 month financial buffer. In your 20s, this buffer is what grants you the options most people don't have, like leaving a miserable job or taking time off without panic. This equilibrium acts as a prerequisite shield. Without it, your hard-earned progress is easily wiped out by an unstable job or a single bad decision. Once you move past simple survival and reach your first million, management is still relatively straightforward, usually handled through a consumer smartphone and a few property deeds. But at the $100 million mark, the sheer volume of capital creates a level of logistical complexity that retail systems aren't built to handle. At this scale, the elite move their wealth into a family office. This is an in-house team of tax attorneys, M&A lawyers, and venture scouts operating exclusively for one family to prevent capital decay and manage international obligations. To see this in practice, look at Jeff Bezos. His private command tower, Bezos Expeditions, reportedly employs over 150 professionals, a network of advisors larger than many medieval kings commanded to run nations. This structure showed its value during the 2019 Bezos divorce. Even with a $36 billion asset transfer, the transition was absorbed behind closed doors. Voting control remained stable, and wealth continued compounding because the framework was arranged years in advance. At this level, wealth is treated like a sovereign institution. The family office structure absorbs external disruption, allowing capital to grow without reacting to market chaos. This raises a specific question. How do billionaires fund their lifestyles if their wealth is locked inside illiquid stocks and offshore trusts? They utilize a 3-part sequence. It starts with buy, where they acquire massive blocks of finite assets, like commercial real estate or founder stock. They never sell these assets, so the capital gains remain unrealized and untaxed. Instead of selling, they move to borrow. By using their asset portfolio as collateral, they secure ultra-low interest credit lines from private banks. They fund their homes and travel using debt, which the law does not classify as taxable income. The cycle concludes with die, triggering a loophole called the step-up indices. Upon death, the legal cost basis for heirs resets to market value. The capital gains tax liability effectively vanishes, leaving the next generation with unencumbered wealth. By deploying this loop, the global elite convert mandatory tax liabilities into a self-sustaining system of asset preservation. Sourcing this data yields zero return unless you apply it to your current balance sheet. You have to run the allocation algorithm based on the capital you actually control today. If you have a high active income but under $100,000 in liquid reserves, you are in the passive compounding pipeline. Your directive is to automate your investment scripts and funnel excess currency into low-cost index funds to let time execute the compounding for you. If you have zero capital but hold uncompensated hours, you are on the active sovereignty track. Trade your time to master a high-income technical skill, using those agency retainers to build a scalable digital or physical asset that prints cash flow independent of your presence. Commit to your current stage. Drop a comment below with the hashtag FUTURE to declare your position on the grid. Financial freedom scales through these predictable thresholds. Treat your assets and your trajectory like an engineered equation and begin the execution today.